Hey guys, welcome to Netflix's quarterly report Q4 23 from a day ago. Very interesting updates. So let's start with economics, engagement and market share. Very strong subscriber growth, and the share price jumped over 10%. And yeah, slowly inching back towards the all-time highs, still a fair bit off, but definitely subs growth exceeded expectations and forecasts. So great numbers. And here's engagement metrics from third party, Nielsen. And we see here at the bottom, Q1, and now the latest Q4, we've got a direct comparison. And what we see is growth in the US being the biggest market, also Mexico and Brazil being markets that they target. And obviously there are some scale effects with the Hispanic population in the US and tastes being potentially similar with Mexico and Brazil and those kind of titles. Stable in the UK, and should be mentioned, let's look at competition. YouTube, also 1% growth in the US, but in the lower income countries, 4% growth in Mexico and 3% in Brazil. UK doesn't separate YouTube out, so we don't know that exactly. But it's not surprising if you watch some of our previous quarter updates on Netflix. This is something that I think we very clearly predicted. But nevertheless, great results for Netflix nevertheless. Where does it come from? Well, if you look here, these numbers grow, it comes from what is called linear streaming or broadcast. So as these numbers grow, broadcast, free TV or whatever you want to call it, they go down. And as I mentioned, Netflix for sure thinks that there's more to be captured from those markets. Disney as probably the main other competitor, well, Prime Video also, but Disney also very strong. They have grown in the UK and stable in the US. And let's move on. We'll be saying a little bit more on competition at the end. Next one, revenue monetization growth drivers. So here basically is their stand on that. Growth and revenue growth drivers are, well, the main one was this time around membership growth. And as we've said in the last few quarterly updates, this was related to the paid sharing or crackdown on the password sharing. And yeah, basically the introduction of that extra membership account that has driven a lot of membership growth beyond what they forecasted, and that was an unknown. And they did say, like, if you look at our Q2 update from 23, we said that that could be higher than what they're forecasting, and that's starting to happen now, or continuing to happen is probably a better one. And yeah, membership growth, the main driver. Paid net additions, 13.1 million members. That is really great, and up from 7.7 last year. So average revenue per member up by 1%, and that is pretty good, because what's happened in the meantime, if you watch the last quarterly updates, they have introduced lower priced tiers in certain countries, lower purchase parity countries, purchase power parity countries, and that therefore they had predicted it's going to be the ARM going to be not growing or remaining flat on a currency adjusted basis. And so it being up by 1% is actually exceeding their forecast. They're still saying it's going to remain flat year over year, because all of that consolidation and experimentation and rolling out new price reductions in some countries, that'll still kind of, yeah, I think is now kind of getting to an end. And then basically in 2024, they will be able to probably have price increases in certain countries. So they say that they've done that a bit in the US, UK, and France last quarter, but as always, it happens during the quarter, so you never see at the end of the quarter the full effect. And again, we spoke about it many times over. Yeah, so I just spoke about this paid sharing or password crackdown going well, and also, yeah, creating a much bigger base from which we can grow. And what they mean is, over time, because these accounts are paying half the membership fees, they are basically trying to say these guys will start to pay more over time. Price increases, so I think the most important, which I'm highlighting here, relative, so this is from our last update, and please check it out because there were some interesting comments that we have said regarding to their pricing strategy, also things you can learn about those kind of pricing tactics, etc. So basically, they want to really, over time, get rid of the basic plan, and they want to have more differentiated customer segments. They want to push either those more price-conscious ones into the ads layer and the other ones into the standard and or even premium layers, which then will go up, obviously. The ads layer has been growing very nicely, 40% in the last quarter-on-quarter, and 70% growth quarter-on-quarter, and 40% of all new sign-ups sign up to this layer, so very successful. And as mentioned, the basic plan will be retired in Canada, UK in quarter 224. And yeah, so there's going to be more differentiation in the ad layers. So, in the pricing layers. If you like this video, please don't forget to hit the like button. We'd really appreciate your help. Growing also on our side. I think we're delivering great free value, so please help us to spread the word. Here is the updated business model canvas. So all the blue stuff, as you see here, we'll be covering in the next few slides. Those are the updates that we have seen in quarter 4, but we'll cover these all throughout. So let's jump to the next one. Very interesting content pillars. I mean, we know all of these ones. Their own IP, intellectual property, in the form of new and original TV series created by themselves. They are starting to really call out the non-English programming more and more. If you have watched our Q1 update, I did criticize that a bit, and but somewhat coincidentally, from Q2 and definitely in Q3 and Q4, they've been speaking quite a bit about this, because global expansion, you can't just have the, English language and taste preferences and assume that you can grow that globally to everyone. So there's definitely cultural adaptations, and they go both ways. They've been watch the Q3 video where we've been talking about it being both ways. Then license titles, that's one thing I wanted to call out. So the analysts basically have observed more license titles from competitors, which were previously exclusively on the competitors' channels and streaming services. And they said, yeah, look, this is Ted's comment. And he said, look, this used to be in the past that way, that we were able, in some cases, to help those kind of shows to reach a larger audience. And not always, but sometimes. And we are very open to licensing business. And I think during the strikes, which now have ended, that was also very useful in their business model. They had some really very successful licensed titles as well as shows. So the other big one that was announced, well, if you love that kind of stuff, from January 25, you can watch live wrestling. I know people who love it. I'm not going to tell you my view of it. You can pick up on it. Yeah, so basically their game plan continuing to be continued investment in content. I'll say a few more words on that one. Very interesting. This is about a half-hour video plus a very long list of 5,000 titles. Their new engagement report. They've been speaking about sharing more openly across the industry the viewing stats, and they have basically role modeled that because they've been sharing their own stats more and more. Very interesting. So it's a half-hour video with their findings that you can watch, or you can download this report. They're saying, well, basically in all categories now, they've been literally 40 plus weeks or 52 weeks in the year. They've been had the number one TV, film, acquired series. So yeah, pretty impressive. And that goes to the point of engagement. We'll say a few more words. And if you want to learn, like now we're covering the highlights, but if you really want to learn within like literally half an hour, all the details, like really, really relevant details of Netflix's business model, check out our business model on a page, BMAP, and absolute, super affordable. Go to our store and have a look. Like, you won't find it any more affordable than that. $3. That is it's literally a joke, but this is our help for lower income countries as well. We want to be able to help everyone. And yeah, your chance to learn in half an hour a business model. And now advertising. Let's cover the other business areas. Advertising, be like literally, I have to say, if you listen to the webcast, the investor webcast, the analysts are really excited about advertising. And I will say they are so excited, Netflix always has to slow their excitement and expectations down a bit. They're saying it's going to take years, it's very early days. We think, I said that last time, I think last time, they think it can contribute around 10% of their revenue in the long run. But yeah, as mentioned, growth rates of 100%, 70%, 70% over the last 3 quarters, quarter to quarter. Now it is 40% of all new subscribers, and they shared a number, 23 million monthly active users. So first time that they actually shared a number, which is great. Obviously, this is the consumer side, and yeah, further growth anticipated. And they're saying they're making the ad plan more attractive. I think they added download feature and higher resolutions, etc. So definitely also value investment there, which also means over time they will try to monetize it a bit better. But yeah, the monetization there is A, on the ads, on the brand side, and B, on the consumer side, and now C, third, it's on the customer acquisition side, because now they got Netflix on us, and that is like larger partners like T-Mobile bundle their T-Mobile plus Netflix subscription into the ad layer into one offering. And Ted said, now the economics stack up better. May have been Greg, the CFO, I actually don't remember. One of them said the economics now work better with the ads plan, whereas with the basic plan previously, that was more difficult to make these kind of bundling offerings work. And yeah, if you know the economics of such bundles, that is the channel partners, let's say economics of channel partners, that is not always easy to make work. So they call it a win-win-win. Win for the consumer, win for the channel partner, like in this case T-Mobile, and win for Netflix. And yeah, very interesting. So it's threefold monetization: consumer, channel partner, advertiser. Obviously, a channel partner expects the consumer to pay for this, but still as at a discount. So there's a surplus benefit for the consumer as well from an economics perspective. And let's continue on. So advertiser. As I've called out, it's for large advertisers only. I think like $10 million investment or advertising spend is like expected to be like at the lower end of it. What they're trying to do technically better: targeting, ad relevance, and measurement capabilities. I mentioned that before. They're working also with a number of partners, EDO and Nielsen and Microsoft, with Microsoft on the targeting side and EDO and Nielsen on the measurement side. Anyway, so they're investing in technical. They got internal teams which are growing. I mean, when I first spoke of it, I think in Q2, the internal team size appeared a bit small. They haven't since then shared the number of internal resources, but they're saying it's growing fast. Plus, obviously, partnering with Microsoft on the technical side, and their own internal teams are focusing on sales and the advertising operations, as well as on the go-to marketing strategy, etc. Ad market, 180 million, but here 25 billion, of course, 25 billion on connected TV, and very important, ad dollars follow engagement, and we got the most engaged audience. So we believe we are well positioned to capture some of that ad spend. Definitely, that shifts from linear to streaming, certainly true. And don't forget, I think in the engagement report that I mentioned, average viewing per day, I think is trending towards 2 hours. I mean, that is like unbelievable. I don't know what people are doing in their free time. Anyway, next area, this is also some excitement there, but it is, even though the games, let's say, business has started before the ads business, it's probably still in an earlier phase than the advertising business. Analysts are excited, ask questions, but yeah, nowhere as much as I see on the advertising side of things, but still. So as I mentioned in one of the earlier ones, the way they see this is not as a side monetization engine. They see this as feeding the big engine, which is obviously the subscribers to Netflix. So there's 140 billion in consumer spend, but that just shows that there's a large market. Basically, what they're saying is they're going to invest in games carefully and track whether that relates to membership value. And membership value in this case means increased retention, if you boil it down to a metric. And games investment is and will remain very small compared to their content budget. I mean, their content budget is 17 billion. That's it's going to always stay quite small, even though it may grow. And the other way to monetize games is licensing. And that's known, it's one of the ways games are being monetized, can be franchise or licensing game titles where they've built the IP and own the IP. So yeah, that's I think that's enough on that one. So again, check out our flagship course where you learn about all these kind of monetization models. It is like literally, it is the best course that solely focuses on the business models of digital businesses. And there's literally nothing on the internet that is better than this and cheaper than this at a per hour rate. You'll be paying literally upwards of $10,000 at an Ivy League, Ivy University to get anything similar, even though I doubt you'll get anything there either. So check it out. I'm not exaggerating here. This is the best on digital business models that you can get on the internet. Then economics and competitor and outlook. So I have mentioned it a few times since even the Q1 update. Competitors come from different areas, linear and broadcast. So they're not worried about linear and broadcast. They say, yeah, we're expecting more mergers and acquisitions among the big players, but we're not worried about this. We're not going to invest into that. We're not going to buy any one of them up to take over their content library and whatever. And I think that makes total sense. More interestingly, they are not mentioning, so they are mentioning YouTube and Disney occasionally and Prime, not very often. Like if you look at word count stats in all the investor stuff, they're keeping it low. They're not overly concerned with those. And I would agree. The one thing I find interesting is that they do not say anything, and that's probably because it's still too early, but they're not saying anything around all the larger potential global markets that they want to capture, because while I agree that like the big broadcasters, they're not going to conquer back a lot of market that Netflix has taken over. Maybe Netflix's growth will taper a bit, but that there's going to be a full-blown pushback and market recapture, that appears unlikely. However, what about, let's say, the Netflix of India, Japan, France, or other countries, UK, where they want to be? UK is culturally too similar to the US, so doesn't really count. But the other ones that could cater to the local tastes and really focus all their financial resources on those tastes, it will be interesting to hear something about that. And we haven't heard anything about that. However, I mean, since I've been covering that for 1 year, they've been saying more on the other things. They've been talking about cultural adaptation and targeting with respect to their tastes in the last 3 quarters, whereas in the first quarter where I pointed these kind of things out, there was absolutely nothing. So it is good to hear something about that. And they are talking about the large players who are continuing to invest, and that is good to have those guys on the radar. But I will say, and totally agree, it is a linear business model, and scale plays a very big role. It is the good old scale advantages, and continued investment will, when you're the biggest player, it will be the most important playbook element. And YouTube is different, right, guys? It's not the same. It is a platform business model. So it's also probably larger and has more engagement, but it is a different offering. So that's not a totally direct comparison. There's a comparison in terms of viewing times and so on, definitely. But it's YouTube as a platform business model, very different. As mentioned, you can learn. I've got like literally an entire submodule on comparing YouTube to Netflix in our flagship course. If you don't know what I mean, after that submodule, you'll understand exactly what I mean. Anyway, let's move on. So their plan is continued investment to scale, and they see other competitors cut back, and that is not surprising. That is what happens in scale businesses, in linear scale businesses. The dominant player continues to invest and have better and better unit economics, and those that are lagging behind and not seeing the growth rates, eventually they stop investing or they slow it down because the forecasts of that investment look more and more dreary. And so the other one I mentioned a few times, not going to go into this one. There can definitely be a shift in the younger generations and younger customer segments to other screen types and formats, etc. And that, for now, they don't have that much. They mention it, but they don't have much of a response to that one. And games is not a response to this. So that could be interesting to observe, but it's more of a long-term thing. Not going to get caught out on that one over the next year or two. And so this is the summary. Basically, continuous improvement, better slate, better content, easier discovery, and more fandom. Fandom is relatively new. I spoke about it the last time in more detail. Check it out. Now, advertising and games as new business areas. They upped their market opportunity now across all of these markets that they're now addressing, and they're saying, well, we're just at 5%. It's very interesting that all companies are always somewhere at or below 5% of their addressable markets, which is promise of more growth, but it's obviously not untrue, but it's also very a promise to the visionary investors, let's say. And share of TV viewing is still less than 10% in every country. I covered that, and I said in the first slide. So that's it. That's their plan. That's been their plan for a long time, and it will continue working certainly for a while. And let's see. Very exciting. Remember, check out our T's and C's. This is not investment advice, and we're never giving you investment advice. This is purely educational and from a business model perspective. Check out our website. We are the only ones who are fully and solely focused on digital business models. Nobody else is. Others focus on all sorts of business models, but digital business models are different. They deserve their own coverage, and that's what we are, who we are. We are your trusted experts in that. So check out our website with free articles, etc. Thank you so much.